Hi, I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. Retail has been one of the best performing sectors in the market this year. However, the driver of the sector's performance has rotated from grocery in the early stages of the pandemic to online and in-home category retailers during the lockdowns and periods of restricted population movements, and now towards the beneficiaries of the reopening of economies, with the distribution of a vaccine becoming increasingly likely in the next 6 to 12 months. The stock I want to talk about today is in the third bucket. Universal Store Holdings is a recent listing on the ASX. The company retails urban streetwear with a focus on consumers between 16 and 35 years of age. While apparel has generally been a lagging segment of the retail market this year, casual and activewear have been the stronger components within the apparel market. Universal's focus on streetwear has helped it through this period, but it was still negatively impacted by restrictions on group socialising and events. Despite a material impact on its sales during the lockdown period, Universal has performed very well, with store sales bouncing back to year-on-year growth just 2 weeks after the 5-week lockdown period ended. Same-store revenue growth accelerated as restrictions on social gatherings were gradually removed in most states, with the company recording 33% comparable sales growth in the 7 weeks from 28 September to 15 November, excluding the 12 closed stores in Melbourne. The Melbourne stores generated sales growth of 23% year over year once they reopened from the 28th of October. This is an acceleration on the already strong growth generated during the September quarter. Many retailers generated a net benefit from the JobKeeper program. Universal's relatively immature online offering meant that its JobKeeper payments merely went to offset the lost gross profit from the sales impact of the lockdown in April and early May. This means that it will not be as challenging for it to cycle this period in the second half of fiscal 21 as it will be for some other retailers. While there is a risk that Universal's core demographic is more susceptible to the expected removal of government subsidies at the end of March next year, offsetting this, the reopening of the hospitality sector will also see a recovery in the younger demographic incomes, while allowing festivals and large-scale entertainment events to recommence, restarting a key purchase occasion for Universal. In the medium to long term, Universal has the opportunity to materially increase its store numbers, to grow earnings with its current 65 stores expected to grow to over 100. Universal is particularly underweight the Sydney and Melbourne markets. We expect one of the features of the upcoming reporting season to be above normal gross margin for retailers as a result of the immediate cancellation of orders as a risk mitigation measure in the early stages of the pandemic. With demand surprising on the upside, retailers generally exited the 2020 financial year with very clean inventories. As a result, margins in the 6 months to December will have benefited from lower than normal clearance activity. This was highlighted in the most recent trading update from Adairs. Universal is also likely to show strong margin performance in the 6-month period. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.